This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone, live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. It is Bloomberg Businessweek Daily on this Wednesday, July 16th, 2025. This is a Fed Wednesday, and it was a Fed Wednesday always because we're expecting the Beige book to cross just any minute. We're going to bring you those headlines as soon as we get them. Stuart Paul is here to talk about it, but also Katie Griefeld. A Fed Wednesday because of everything happening at the White House and reports out of Washington about the fate of Jay Powell.
Yeah, a lot of back and forth here. I have to say I had to leave the building at about 11 for an hour.
Okay.
And in the time that I was out, when I left, apparently he was considering firing Jerome Powell soon. And now I'm back, and the reporting is currently that no, it's not out of the realm of possibility, but it's not imminent, it sounds like.
Well, we did see whipsaw in equity markets when that happened. There was some relief when the president said he wasn't going to do it, but certainly moving markets, and we'll see what happens. There's really just less than a year for Jay Powell's tenure, so we're going to talk to Stuart Paul about that.
Less than a year for his tenure as Fed chair.
As Fed chair, yes.
For Fed governorship, I'm sure we'll discuss that too.
We certainly will. As I mentioned, we are awaiting the Beige book to drop. This is the anecdotal information that we get from the different parts of the Federal Reserve System, the different areas of the Federal Reserve System. We often look at that for different anecdotes about what's happening in the economy. We're going to be joined in just a minute by our Bloomberg Economics US Economist, Stuart Paul. He's standing by. He's going to give us everything we need to know about the Beige book and give us all things Federal Reserve. We're also going to hear from Mike McKee a little later in the hour. And Katie, I don't think I reintroduced you to everybody.
No.
You don't need an introduction, but Katie Griefeld is in for Carol Masser this afternoon. She is, of course, of Bloomberg News and Bloomberg Television. You catch her on Open Interest every day on Bloomberg TV. Speaking of Bloomberg TV, a little later, we're going to hear from Brian Moynihan. He's sitting down with David Westin. This on a record quarter for Bank of America when it comes to trading.
Absolutely looking forward to that. We're in the thick of bank earnings. It seems like trading revenue has been popping off, especially for Goldman Sachs. This will be interesting to get the readout from the C-suite at Bank of America as well. It looks like we're getting a little bit of trickling headlines from that Beige book. Apparently, activity increased slightly from May to July. This, of course, coming from the Beige book survey of U.S. economic conditions.
Okay. Stuart Paul is a Bloomberg News US Economist. He joins us here in the Bloomberg Businessweek studio. Stuart, we're going to wait for more of these headlines to come in. And, you know, we were planning to talk to you when we booked you about the Beige book. But I want to start with everything happening in Washington, D.C. when it comes to the Federal Reserve, because we got a bit of mixed information from different sources about the fate of Jay Powell. We saw markets react, of course, as potentially they would react if he were to step down or be forced out of that role. From an economics perspective, how do you look at what's happening to Fed Chair Jay Powell?
Well, it's unfortunate because, as we know, there is no such thing as a free lunch, but the closest thing that we have to a free lunch in economics is a politically independent central bank. Going back to research from the late 1980s by Larry Summers, friend of Bloomberg TV, we know that independent central banks tend to deliver lower, more stable inflation with very little cost in terms of foregone GDP growth. Speaking of GDP growth, as Katie mentioned from the Beige book, reading from the PDF here, economic activity increased slightly from late May through early June. Now, when we break it down and look at the 12 different Federal Reserve districts, 5 reported slight or modest gains, 5 had flat activity, and the remaining 2 districts noted modest declines in activity. Rotating to the labor market, employment increased very slightly overall. Now, something to keep in mind is that when we're digesting labor market data, some folks might have breathed a sigh of relief because the unemployment rate ticked down. But as we're hearing from this soft data, employment's increasing just very slightly. And it's concentrated in just a few districts. Part of the reason the unemployment rate is ticking down is because there's relatively less labor supply. So we're starting to see some of the details of the hard data matching up with the somewhat softer soft data that we're getting from the Beige book right now.
Exactly. That's why we like to look at the Beige book for that anecdata, for that color, helps to fill in some of the hard data here. I just want to talk about Jerome Powell a little bit more because you read into what President Trump told reporters on Wednesday. He said, no, we're not planning on doing anything. I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud. So we know that there's been a kerfuffle over the renovations with the Federal Reserve. It feels like perhaps the president is leaving that door open.
It does look that way. The thing to keep in mind, though, I think, is that a lot of the discussion about renovations, a lot of this idea about fraud is really just red herring. It's an attempt to find a cause that gives the president the statutory authority to remove the Fed chairman from office. What he really wants is lower interest rates. What he really wants is lower debt service costs. But the thing is, if he were to attempt to remove the Fed chairman, markets would start to feel that acid reflux. They would start, as we saw with interest rates, 10-year selling off on this, temporary news, the flash headlines that the president was considering firing Powell. It's very likely, actually, the case that if the Fed chairman were to be fired so that he could be replaced with someone to deliver the president's preferred lower interest rates, debt servicing costs would actually rise as the term structure steepens. It's the exact opposite of what he says he wants.
Well, let's take a listen to what President Trump said earlier today. This was in the Oval Office. We were airing it live. He was along with Crown Prince and Prime Minister of the Kingdom of Bahrain. This is on Fed Chair Jay Powell.
He's not doing the right job. We should be saving $1 trillion a year in interest. When he talks about costs, we should be saving. Think of it, $1 trillion a year. Add that with the tariffs and everything else. But he just doesn't want. He's a knucklehead.
The president calling the Fed chair a knucklehead. We should remind everybody that the president was the person during his first term who nominated Fed Chair Jay Powell for his first term. He was then reappointed and confirmed during President Biden's administration. What do you make of that $1 trillion figure? Is that on your radar at all?
Well, it's just completely off. It's if you were to install a Fed chairman who has the objective, the stated objective of essentially monetizing the national debt, as it sounds like the president wants to do, as he calls the current Fed chairman a numbskull or a knucklehead or a total stiff, as that happens, bond investors need to account for additional inflation compensation, higher average expected inflation rates over the entire rest of the term structure. So you would see maybe some rate cuts additionally priced in. You might even see lower 2-year bond yields. But if you think it was a little bit jarring to see the 30-year breach 5% just yesterday, now 5.06 or wherever it is, we would definitely see the 10-year shooting back up above 5%. So you would see just a total rejection of that idea. The actual debt servicing costs would not come down by any trillions of dollars.
Could you build a case for cutting rates here, though? You think about inflation. We got CPI yesterday. That was exactly in line. You got PPI this morning, unchanged on the monthly figure. We haven't quite seen the labor market weakness, but there have been some anecdata to suggest that maybe that's coming down the pike. I mean, you add it all together, could you build that case?
I think that the simplest case for cutting rates right now is that basically rates are currently where they were when we had nominal GDP growth of about 6 to 7%. Right? Nominal GDP growth being the dollar value of the economic activity in a year. And currently we're running at a nominal GDP growth rate of about half that, the bulk of which is inflation. So should rates be as restrictive when there was twice as much economic activity and growth in economic activity? And frankly, you would get people on the committee, including folks like Chris Waller and Mickey Bowman, who'd say, no, we could start delivering rate cuts perhaps as soon as July. But when you see anecdata from the Beige book today, where the most pervasive and the most concentrated set of answers in that anecdata is that around the country, you're seeing relatively hot price increases. You're seeing 7 of the 12 Federal Reserve districts saying price growth is at least moderate, 5 saying it's modest, mostly similar to the previous report. It's not like we're seeing any softening of price pressures. You still have those pipeline price pressures.
We're not seeing softening, but we're not seeing the price pressures go up or prices go up like many economists thought 3 months ago they would as a result of tariffs. Why is that?
So we're starting to see some offsets, right? So some softening of shelter costs, you see some drag from airfares, But the things that are touched most acutely and most precisely by tariffs, things like appliances, home furnishings, clothing, those are seeing rising, in fact, accelerating prices.
Is that because they're a smaller part of our economy? We're a services economy, so we're not necessarily seeing the impact of these increase of prices of goods in the headline numbers?
That's part of it. But the Fed is still looking to prevent inflation expectations from becoming unanchored. A lot of the goods are things that we interact with very regularly. We interact with the grocery store very regularly. It's a notable development when you have to replace an appliance and you realize it's going to cost twice as much as you expected. Mm-hmm. Those are things that weigh heavily on Americans. So even though it's the case that, yes, rent accounts for a larger share of their total spend than something like appliances, a lot of the time your rent is just deducted from your checking account. It resets every couple years when you sign a new lease. For homeowners, it's the sort of thing that's very stable over a 30-year mortgage. So when inflation expectations are part of the game for the Federal Reserve when it comes to setting rates, they are going to be paying more attention to goods than one might suspect.
And I mean, to that point, something I always wonder is how interest rate sensitive this economy truly is. Because you think about buying a home, mortgage rates, okay, you interact with that not too often. Car payments, maybe you interact with that a little bit more. But one of the explanations for why we weren't seeing, inflation or activity or spending cool down when we had such high rates, and I suppose we still do on a relative basis, is basically that this economy isn't as sensitive as it was to interest rates. Does that argument hold water with you?
That still does hold. So yes, the U.S. economy is relatively insulated from the effects of higher rates. And part of that is because homeowners locked in mortgage rates that were below 4%. So it's still the average mortgage rate on all mortgages that are outstanding in the U.S. economy is just a touch above 4% right now. Nothing even close to the mortgage rates, around 7% that are offered for new mortgages. So the transmission of monetary policy into the real economy is relatively slow. But with home price appreciation slowing pretty dramatically, we expect just full year growth of about 1% for home prices. You will start to see more material slowing in rents, in owners' equivalents of rents, and you also are starting to see softening auto prices, which is a consequence of persistently higher auto loan rates.
And Tim, you mentioned that I anchor this show in the morning. It's called Open Interest. I've already spoken to Stu today. The conversation we were having, though, was about Kevin Hassett versus Kevin Warsh when it comes to the Fed chair replacement. We've been talking so much about Kevin Warsh, but there's another Kevin in the race, according to our reporting, and that is Kevin Hassett. So just give us the overview here. What do we know about Kevin Hassett, what his stance is, and how that might translate into a Fed chair, Kevin Hassett?
Kevin Hassett has been a very vocal supporter of the president. He's been a reliable alternative voice coming from the administration, making the rounds on Sunday shows. Most of his experience, though, is more so in tax policy, which is why it was useful to have him in the White House, helping to shepherd across the one big beautiful bill. He's a little bit more difficult to read in the context of monetary policy. Kevin Warsh has his experience as a member of the Board of Governors during the George W. Bush administration, and so it should be easier to get a read on him. What's difficult, though, and why it's a little bit tough to say what we'd expect from an outsider at this point, now 20 years basically removed from the job as Kevin Warsh is that he was very critical of the Federal Reserve for maintaining especially low interest rates from the global financial crisis through basically 2018. He was very critical. But he's basically interviewing for a job where he's going to be asked to cut rates into an economic expansion. And so there's a little bit of intellectual inconsistency between his criticism of the Fed as an institution and the job that he's interviewing for. So I think to sort of square the circle between candidates, Kevin Hassett might be someone who's easier to put into that role, but I don't think that it's necessarily a mortal lock that he would be an easy confirmation in the Senate. He's someone who's been very critical of the Fed and its forecasting failures. Right. But this is someone who published Dow 36,000 on the eve of the bursting of the tech bubble And so he would certainly come under fire for his own forecasting failures 25 years ago.
Well, we did hit Dow 36,000 a few years ago, so he ended up being right. Just
very early.
A couple decades. Couple decades of timing. Stuart Paul, U.S. economist for Bloomberg Economics on the economy and all things Fed Chair Jay Powell. I want to bring in Gina Martin-Adams. She's chief equity strategist for Bloomberg Intelligence. She joins us here in the Bloomberg Businessweek studio. You're watching the market reaction to everything happening out of Washington. We saw stocks fall, and then they kind of bounced back to where they were before this message from the president a little earlier. What would happen to the equity market if Jay Powell were somehow fired or forced out?
Well, I think it is pretty destabilizing, as we did see when the rumors were flying that today might be the day. Once again, the equity market had a bit of a hiccup. So I do think it's pretty destabilizing. Ultimately, the equity market in these instances largely takes its cues from what's happening in the bond market as well as currencies. So I think the dollar is extremely important to watch right now. The dollar is still down, even with a little bit of a recovery post-news event where Trump sort of walked back any kind of concerns that he was going to fire Powell immediately. I think there's a bigger risk at play here that the dollar may be signaling, and that is maybe Trump doesn't fire him, but it actually goes through the process with Congress, and ultimately he gets fired that way.
But
that's
I mean, but he's out in May anyway, so at least out of as Fed chair,
yes, thank you.
Not off the Federal Reserve.
Yeah.
But
yeah,
I know. I completely sympathize and understand that, but nonetheless, there does seem to be some urgency on the part of this administration to want to make this happen one way or another. So I think you watch the broader markets, the macro signals are pretty important for stocks. In the meantime, stocks are in the midst of the earnings season. So they're obviously going to focus predominantly on the signals from companies. And then to the degree that this is impactful, it impacts stocks through those other asset prices that do have an impact on valuations.
Well, just to point on what we saw, the market reaction to some of those headlines. Anna Wong over at Bloomberg Economics writing, we think Trump is testing the waters to see whether he can fire Powell. The sharp market reaction appears to have convinced him to pull back on the firing rhetoric for now. So we'll watch that space. But when it comes to earnings, let's talk a little bit about what we saw so far. It's mainly been the big banks, but the reaction to Wells Fargo yesterday, I believe they cut their guidance, to BlackRock missing their estimates when it came to inflows, it was punishing.
Yes.
And you think about the sentiment in the market right now, is that what we should expect, that misses will be much more punished than maybe they have been?
Yeah, and I think you said the key term, and that is guidance. So misses to the outlook are especially important because the market is priced to assume a beat to the current, right? And this is really tricky because the consensus was so low coming into this earnings season that it's inevitable that these companies are going to beat extremely low expectations from the sell-side consensus. Yet at the same time, financials on a relative price to book basis are trading at their peak levels in the last 5 years. So very, very expensive stocks relative to the recent past anyway, contrast with very low expectations. What that means is the market expectation is very different than the analyst community expectation. And the market expectation is really about the future. It's about a much greater return of capital to shareholders likely to come from this group. It's about deregulation, ultimately removing the so-called shackles of the financial sector, allowing for faster growth. So to the degree that any of those assumptions are questioned, that creates the risk. It's about the future. Are we going to actually sustain these new assumptions for much faster growth coming out of financials or not?
Gina Martin-Adams, chief equity strategist for Bloomberg Intelligence, joining us here in the Bloomberg Businessweek studio. Gina mentioning banks, talking about banks. Coming up next, an interview with Bank of America Chairman and CEO Brian Moynihan. That's next on Bloomberg Businessweek Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. It has been a volatile trading session. Right now we have got the Dow, the S&P, NASDAQ. They are all advancing. All eyes on Washington. Bloomberg Television and Radio, we got you covered. President Trump denying that he is seeking to remove Fed Chair Jay Powell, saying to reporters this morning, quote, "No, we're not planning on doing anything." Stocks initially sold off, rebounded. Right now we have got the Dow, the S&P, NASDAQ in the green. Should point out that the NASDAQ NASDAQ 100 index does, however, remain lower. So here's where we stand. S&P up 8 right now, 62.51. At one point this morning, we saw the S&P dip to as low as 62.01. You'll recall that yesterday, trading at a record 6,300 on the S&P. Right now, up 0.1%. The Dow up 115, up 0.3%. NASDAQ up 14 for the NASDAQ Composite Index, a gain of 0.1%. 10-year 4.45%. The 2-year 3.88%. Gold up $30 the ounce, higher by 0.9%. And West Texas Intermediate crude down 0.1%, 66.41 for a barrel of WTI. Bank of America shares trading lower after earnings, down now by 0.7%. Coming up 2:30 p.m. Wall Street time, our David Westin will be sitting down with Bank of America CEO Brian Moynihan. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, the second batch of big banks reported earnings today. There was a theme: market volatility sparked by the trade war, leading to record quarters for traders. Goldman stock traders posted the largest revenue haul in Wall Street history. Morgan Stanley stock traders scored their best second quarter on record. And Bank of America traders also posted a record second quarter. Watching all of this closely, Ken Leon, Director of Equity Research at CFRA Research. He joins us from Florida. So record quarters for trading across the board today, yet the stock reaction to the downside. Why is that?
Well, it's great to be here. And when you look at the global U.S. banks, they performed very strongly. What we did see was not only trading, but the elevated markets means that fee income across many different businesses like asset management, wealth management, other services generated substantial year-over-year growth. What we are also seeing is how the capital markets can be the delta for getting stronger growth, and also higher estimates expected from the street looking ahead, both for revenue and earnings. Those that are more balanced or exposed to Main Street America, consumer and small business, are likely to see much slower growth and some risk of kind of sluggish demand in the future. I think that's really the difference between the outsized significant performance of Goldman Sachs, strong growth for Morgan Stanley, and then those that were kind of in between were the JP Morgans and then Bank of America, which didn't fire on all cylinders. That's the difference.
But Ken, still, I mean, when zooming out from just today's action, even though, I mean, Goldman only being up 0.5% after posting a record quarter when it comes to trading, what is the driver of these financial shares? Is it the yield curve? Is it actually the numbers that we get in the earnings report? Is it something else? Because I feel like I go through this puzzle at least 4 times a year when we get these earnings.
Yeah, lucky for you, 4 times. For me, it's every day. And we've been overweighted the financial sector really since last November. And the large banks are, in the top 10 of that sector. And what we've seen even in the second quarter or year to date is tremendous performance, more than 2 times the S&P 500 for diversified banks. But that's not the point. The key point is, where do they go from here? We think the delta, not only for the rest of this year, but really these stocks are going to be priced on 2026 earnings, is going to be how they do into next year. Obviously, 2 to 4 rate cuts, some easing on the regulatory framework, and then also some opening up in the capital markets for investment banking. That's going to help these banks. When you look at them, in terms of PE multiples, or what Gina was talking about, the overall market, they have to earn into these valuations or multiples. When we look at more conservative metrics, which a lot of bank analysts look at, because they're a conservative lot, such as price to net tangible book value, they're pretty expensive. But I think it's earnings growth and what that does in terms of confidence that they can still have upside over the next year or two. That's the key.
Ken, I'd be remiss if we didn't ask you about the drama with regard to Fed Chair Jay Powell. The reports emerging early today that he would be fired by the president, and the president was seriously considering doing that. We saw a market reaction from the equity side and from the fixed income side. And then just a little later in the morning, we heard from the president, who denied that he would do that imminently. Yet there are certainly concerns about the way that the president feels about the Fed chair. We all know that. What would it mean for banks if this were to happen? Would it mean anything?
So I'm a global director, and I look at markets all over the world. And also when you look at the bond market and really the 10 and 30-year Treasury, the Fed really matters. Its independence, the respect and responsibility of its two mandates for inflation and full employment. I just think this is color or drama. Jay Powell is highly regarded. And the other issue, of course, is when his term is up next year, likely probably to retire, but he could stay on for a few more years as a governor.
Okay, so what would happen, though, if he were forced out?
I don't see that scenario.
You really don't?
But at the end of the day,
even if they were to find some potential, look, the president has targeted the handling of the Fed renovation. What if there's something there and he can push him out through that?
So President Trump's going to get a dovish Fed chairman in part. Nobody's really hawkish today. The data will suggest possibly a slower U.S. economy rest of this year, which is why we're much more positive on the delta of the capital markets, not Main Street America, to help large banks' earnings. So we're just going to have to see. But, overall, Fed's going to be independent. And, of course, we're going to get rate cuts either way.
I have a thought as to what would happen to the banks if Jerome Powell were forced out. You would see a lot of volatility, and the banks would probably trade it, Ken. And that brings me back to all of these trading records that we saw, at least for Goldman, and then these bumper quarters that the other big banks put up. Of course, we know what happened in April. We had Liberation Day at the start of the month, and then we had the walk back. And it seems like that was a big boost for these banks. And the question that comes about is, how sustainable is that? When you think about all of this revenue that's being made in training, how sustainable is that?
It's not the trading. You really need to focus on financial sponsors, which are the large private equity firms. They're sitting on $2 trillion of companies they own, they have to monetize in some way, and also afford the investment bankers to get that job done. That's where I would really look as a delta that we haven't seen really in the numbers and size as it relates to mergers and acquisitions, equity underwriting, or other forms of transactions. Look to lower rates, making it more appealing to valuation for both public and private transactions. That's going to be a bonanza for the large banks.
Ken Leon, Director of Equity Research at CFRA. Thanks so much, Ken. Good to see you this afternoon. As we mentioned, Bank of America traders posted a record second quarter as the company reaped the benefits of volatile markets and net interest income top analyst estimates. For more, we sent things on over to David Westin. He's standing by with Bank of America Chair and CEO Brian Moynihan. Hey, David.
Thanks so much, Tim. For our Bloomberg audiences worldwide, this is Bloomberg. I'm David Westin, and this is Brian Moynihan, who's the Chair CEO of Bank of America. Brian, thank you so much for being back with us. Really appreciate it on this busy day for you.
Oh, it's great to be here, David. Good to see you again.
So let me start with one of the favorite questions I have for you, because you at Bank of America have a window into so much of America, consumers and businesses of all sizes. You sort of have a sense of where the pulse of America is. There's been a lot of changes announced and talked about in Washington. Do you see from your customers much reaction to that, either to the talk of tariffs or the one big beautiful bill? Do consumers or businesses, are they changing their plans because of that?
So if you look on the consumer side, in our 70 million consumers who engage with the economy every day, and they send through their accounts and spend the cash and everything, about $5 trillion a year. That grew up 4% plus. The second quarter 25 or the second quarter 24. So they, because they're employed and because wage growth, and that's not every single consumer, but in the main, they are continuing to grow and spend more, and that helps the economy. And so you're seeing in some of the moderate income households, there's a little bit of moving around to different things. You're seeing people trade from one thing to another, less planes, more cruises earlier. That's leveling out now. A lot more going to movies because the movies are good. But at the end of the day, they're spending discretionary necessary at about the same percentage they traditionally have spent. They've got money in their accounts. They're employed, and the wage growth has been relatively strong, and so they're in pretty good shape. The credit quality is good. They have equity in their homes. They're low rate financing and mortgage, so consumers pretty good. When you go to small businesses, that's more the question. Small, medium-sized businesses, because the interest rate environment hits them harder because they borrow on lines of credit short-term for a lot of their activities, and that rate went up substantially. And then you think about if I'm a $100 million company, a $50 million company here in North Carolina, and I'm engaging in the world finance, I'm importing goods and manufacturing them, further manufacturing them, selling them. It got pretty interesting here trying to figure out all the trade and tariffs. So I think the certainty on the tax rate helps them. Meaning the big, beautiful bill passing and the tax rate, that's a very good thing. The alternative would not have been good if their tax rates would have changed. A satisfactory resolution to the trade so that they could learn the rules of the road over the next 30, 60, 90 days and get their plans for next year put together. And I think ultimately we're going to have to have a satisfactory resolution on immigration and population growth, because at the end of the day, what I'm hearing more from the construction companies, farming companies, and travel and entertainment type companies is I'm starting to worry about, I'm starting to struggle with labor availability at any price, and that's not that we got to make sure they have the workers, because they will supply great service. The economy will continue to grow.
One of the things you reported today was net interest income, which is really important to all banks, but particularly Bank of America, and just steady growth that you're showing in that. How sensitive are you to the rates set by the Fed? If that comes down substantially, does that affect Bank of America much?
So embedded in our estimates, so we've told the world that this quarter we had $14.8 billion in net interest income, and that is the fourth straight quarter of growth, and came off the floor last year. This quarter, when I was talking to you, was the lowest it's been. This quarter was a record in the company's history, and we're saying we're going to grow from that record to 15.5 to 15.7 in two more quarters, the third quarter and the fourth quarter. That embeds in it the rate cuts in the market that are expected by the market. We only show it that way. If you have rate cuts above that, that would hurt that number, but it would still grow, frankly. And the good thing about that is because of great loan and deposit growth, 7% loan growth, 4% deposit growth over the last year, that's in the system. That's capitalized in. I mean, that's here. It doesn't go away. And as that continues to stay and we add to it, what you're starting to see is that sets us up great for next year for further NII growth and further EPS growth. So this quarter was the trickiest quarter to get through, because year over year, we finally got some NII growth, but year over year, the markets business doing strong, so expense growth was a little more robust. That'll get in line, and then you'll see NII drop to the bottom line, and it will set up for 2026 with even more growth.
When you talk about 2026, one of the things we're going to have is, in all likelihood, a new Fed chair. There's been a lot of talk, even today in Washington, about the Fed chair. And you've said you believe in an independent Fed. But if, in fact, President Trump gets his wish, as is his right under law, to appoint a new chair who will be more in line with his views. He said he thinks the interest rate really should be at 1% or even below that. Is that good for Bank of America? Is that good for the economy?
Well, let me make two things. One is, you're absolutely right. In May of next year, the term of the current Fed chair ends after being reappointed, and it's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency, and they're meant to be outside the purview of the executive and the Congress. They are called to task, and they're monitored, and they're reviewed, and all the things. But the reality was it's set up to be independent, so that our central bank in America was independent. So I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision. Because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly. On the other hand, if you think the prior Fed has been slow to lower rates, you might lower them faster. Our team believes that the Fed will lower rates in the second half of next year by 100 basis points. No change until then, because inflation is still going through the system. That brings the Fed funds rate down closer to 3, which they think is is probably more of a long-term rate, and frankly is more similar to what we had for most of American history. What's been unusual is the period after global financial crisis, a very low interest rate structure. That is really not a good place to be, honestly. We'd rather have a higher interest rate structure, a little more inflation, a little more robust economic growth. So I think everybody has to be a little careful about keeping that engine going, because if this engine fails, the whole world fails.
You also reported increased loans from Bank of America, which is good news for you. Tell us about your competition for that. We now have private credit really coming into that area substantially. There's talk that maybe that would be peaking. Is that the way you see it?
Well, I think that so if you think about all our loans, $1.1 trillion of loans, say half from the consumer, and so there's not, that competition's always been there. Half of what goes on for consumer lending goes on outside the regulated banking industry. That's been true for a long period of time. We saw growth across all the segments. We feel very good about that. We go to commercial, the private credit affects sort of the leverage finance and some of the areas, and it's been an effective competitor. It's grown. I think we in the industry and we in the company, Bank of America, have come back with a way of operating we think is consistent with our credit quality, consistent with who our customers, and will also deliver a competitive product. And we grew commercial loans, leave aside the market-based business, we grew commercial loans, I think 7-8%, excluding the CRE office that we are running down still, in the middle market, which is as strong as anybody, and we feel very good about the credit quality of those loans. But more importantly, we feel good about the 30, 50, 70-year corporate relationships we have. And if they want a different kind of financing, we'll bring it and take it to the market for them like we've always done.
You also had a great quarter in terms of trading. Give us a sense about where you're going with your trading activities and your investment bank. In the past, you've added more balance sheet strength to that. You've come up in that. Do you plan to keep doing more of that?
Yeah, and so Jim DeMar and the global markets business, which is the trading business, as you call it, they are up 15% year over year. Both fixed income and equities were up. And he has had 13 straight quarters, I think it is, of year-over-year quarterly comparison growth. And so there's some ebb and flows in that business. But this quarter started off a little interesting with Liberation Day, and I think the first 4 of the biggest days ever in equity stock trading occurred in the first week of April or something like that. So it was a pretty wild time. But over the course of the quarter, it got more stable, and they made it. We have given him more capital and more balance sheet, him and the team, more importantly. And that team, under his guidance, has delivered on it, is getting a good return on it. And we have lots of capital. If he can put it to work, there'll be more of it. The trick is he's also got to use it efficiently and get that return on tangible common equity, return on allocated capital straight. When you go to investment banking, look, April was kind of quiet, especially on the M&A side for us. It came back, and you saw us, as recently as 3 or 4 weeks ago, we thought we'd do $1.2 billion. We did $1.4 billion. And with pipelines full, Matthew Coder and the team are out there driving at it. We lost some deals to other people in the M&A. We were on the wrong side of the trade. That happens. But the reality is what really changed over the course of the months was the financing side kicked in. And that's 3/4 of our revenue, and that was good. And that's why the revenue came up. And that team does a good job, and there's lots of places to grow. That is going to be much more dependent upon the IPO markets being open, the M&A markets, the M&A taking place. And I think with stability, again, back to the tax bill, some trade stability, and then, frankly, deregulation, you're going to see, I think, that activity keep kicking in as we move through 2025 into 26, which will be good for the economy because it creates a lot of activity, investment, changes in businesses, and all those things that we expect to see.
You took time out from your earnings announcement to really focus on artificial intelligence, something you have been talking about for quite some time and adopting, for example, with Erica that you have. Give us a sense of how that's changing the business at Bank of America, for example, on the expense side. Does it really lead to saving some costs?
So in the end of the day, the artificial intelligence, as we know it, is an extension of a series of technology capabilities that allow us to take work and have machines do the work and people and enhance the people's ability to do more work and do more things and spend more time on things that aren't capable of going through that. AI just gives you a different attack surface, for lack of a better term. In the past, we had 300,000 people 15 years ago in our company. Today, we have 212,000 people. The company's bigger, complex, more transactions. From that time, our digital logins were probably, 10, 20 million a quarter, and we felt good about it. They were several billion, they're a billion a month, just to give you a sense. So think of all the investment to do that. But that digitization was customers doing things on their own at 10 o'clock at night and 7 o'clock in the morning, and that allowed us to save our time for our people to go out and help customers solve difficult problems. What AI, the places we think AI has real help is in the preparation of our relationship management force and our small business bankers, our business bankers, our commercial bankers, our wealth management, our investment bankers, allows them to be much more prepared. So we're using those tools to prepare the information, pull it together, because it can take text and manipulate it and put it into the forums and the capabilities. So that's a big thing in front of us. We've done 500 or 700 pitches so far, and that cranking up. We see it in employee self-help. If you had a computer that went down at Bank of America, you can click on Erica for employees, and a chatbot will take you all the way through the replacement of your computer process, and it will involve no people, and you'll get the computer delivered to you. So, that's how we took that same Erica model that 20 million consumers use 200 million times a quarter and turned it internal. And so there's all these applications, and we think it has high application for the services business that Bank of America's in, and the ability to keep doing work. And in the end of the day, we'll have teammates who will harness it and take it and use it to their advantage to make themselves even more successful. So, when we talk to teammates, we say, embrace this, let's drive it, and then let's figure out what job you're going to do, but you're going to need this to be able to do any job in this company.
As you move forward with artificial intelligence, is it changing what you're looking for in the people coming in the door, the entry-level people?
No, we're just in the process of bringing in our 2,000 plus kids, new hires that just started, I think, this week. So think about that. 2,000 kids arrive. 1% of applications, less than 1% were accepted. So we had 190,000 applications and around 2,000 people coming in. So we're getting the best of the brightest. We love them. They're coming in. The point I'm making is there is a group that has to use computer skills and data skills, and that's one set of things. But everybody has to be able to use AI to help them be a better employee at Bank of America. So as you think about that, every teammate, and I have high confidence kids coming out of colleges are going to be a lot better AI than you and I might be, David, but we'll catch up to them someday.
One last question, Brian. You've said that you're moving towards stablecoin, as some other banks are as well. You saw Mr. Bailey, who's the governor of the Bank of England, really said that might have systemic risks because it takes some of the money out of the banking system. You'd be better off going a different direction. Are you worried about systemic risks from stablecoin?
So one of the questions, and I think what Mr. Bailey was talking about, is a question I think the banking system, the United States, the policymakers have to think about, which is, think about the money market mutual fund. About $6 trillion of deposit banks moved to money market mutual funds, and their utility was to invest in short-term, deposits, treasury bonds, et cetera, commercial paper. They can't invest long-term. So their ability to help the economy is really a limited amount. That $6 trillion is outside the system. If you said we're going to take the $18 trillion or whatever is in the banking system today, another $6 trillion out, you'd have to think through the policy ramifications, because to keep it stable, you have to have it invested in a very narrow place. And I think that's what Mr. Bailey was talking about. I think that dialogue is going on. Now, there's another side of this, which means those deposits will come back in the system if we hold the deposits effectively in escrow or custody for our customers who are out engaging stablecoins. So I think there's a lot of turns in the track between where we are today and where we might be on this. Our view is pretty simple. 10 years ago, you would have said the clients don't need a thing called Zelle, and now they use it twice as much as they use checks, and it is used more times than the amount of checks written by our consumers and the amount of cash transactions taken cash out of the M. So it's become the dominant payment network for consumers outside of card. That didn't exist 10 years ago. So we got to have the consumers adopt this. If they want it, we'll build it, and they'll use it. And if it's a way to transact, we'll be there to help them transact. We think, small balance cross-border transfers, in-app sort of manipulation purchases, all these types of things are applications for. But at the end of the day, it's our customer who needs to say, I want to move money. I want to move money into euros. I want to move money into stablecoin. So we've got to be able to do both for them.
Brian, great pleasure to talk to you. Thanks again on a busy day for joining us. That is Brian Moynihan. He is Chairman and CEO of Bank of America. And now back to you.
Thanks so much. That, of course, is David Westin of Bloomberg Wall Street Week. Catch new episodes every Friday at 6 p.m. Wall Street time on Bloomberg Radio and television. Also, a big thank you, of course, to Brian Moynihan for joining us there as well. Few headlines from that interview. Brian Moynihan saying it is the president's right to pick the next Fed chair. David Westin, of course, asked him about everything happening in Washington with regard to Jay Powell.
He also said on the topic that an independent Fed is critical to the U.S. and that a stable and independent Fed is key. Of course, they also spoke a little bit about Bank of America's results, their second quarter trading revenue beat estimates. But you made the point to me while we were listening to that interview and watching the headlines roll in. It's the president's right to pick the next Fed chair. He did pick this one specifically, though.
He did, yeah. Back in his first term, he picked Jay Powell. Then he was reappointed, of course, by President Biden during President Biden's term and confirmed by Congress. Bank of America shares, by the way, they are down about 0.5 percentage point right now. Let's get on over to Charlie Pellet, who's standing by. We got about an hour and 14 minutes to the close of equity trading, but Charlie, who's counting?
Well, we are, because that's what we do here at Bloomberg. We got you covered on the closing bell, Bloomberg Radio and Television, and of course, all those fast-moving developments today that move markets out of Washington, D.C. Lower right around 11 o'clock with the S&P falling to just about 6201. You'll recall yesterday, the S&P was at a record 6,300 briefly. Here's where we stand right now with the S&P up 14, 62.57. That is a gain of just about 0.2%. The Dow up 165, up 0.4%. NASDAQ, the composite index, up 31, up by about 0.1%. The NASDAQ 100 index calling that flat on the day right now. The 10-year 4.45%, the 2-year 3.87%. Gold up 0.8%, 33.52 the ounce. To be clear, 33.52 the ounce. And West Texas Intermediate crude flat on the day, 66.50 on WTI. Speculation about the fate of Fed Chair Jay Powell setting off a short-lived tempest in financial markets, with volatility mostly quelled after President Trump said he has no plans to fire the central bank chief and was discussing it only in concept. United Airlines reports after the close of trading. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, as Charlie mentioned, we're watching everything happening out of Washington when it comes to Fed Chair Jay Powell. President Trump denied that he is seeking to remove Fed Chair Jay Powell after raising the idea in a closed-door meeting with congressional Republicans that leaked to the media. I want to bring in Michael McKee. He's Bloomberg News International Economics and Policy Correspondent. He joins us from Victor, Idaho, where he is for the Rocky Mountain Economic Summit. And Mike, I take it there's a lot being talked about among the Federal Reserve bankers who are there, among the pundits who are there. What is the conversation happening in the wake of everything we heard this morning from the president and from reports before the president spoke?
Well, actually, Tim, there's a bit of an eye roll going on with a lot of people because we've been through this so many times with Donald Trump, and the whole idea of taco came up again. So nobody was surprised when he came out and denied the earlier reports that he was ready to fire the president, perhaps as early, fire the Fed chair, perhaps as early as today. But the general feeling has been, and we talked about this a lot at dinner last night, that the president won't do it because it doesn't get him very far. It would probably, as we saw this morning, lead to a steepening of the yield curve, a widening of spreads, the dollar falling, and interest rates would go up rather than down in the markets. And it would just create a lot of confusion and hurt the Fed's credibility. It would also end up in court. So he might try to remove the Fed chair, but it would take many months of legal maneuvering to get that far. And really, Powell doesn't have that much longer to go as chair.
You said that there was a little bit of eye rolling because this is sort of a movie that we've seen before. Let's take a listen to the rhetoric from the president just over the last few months when it comes to the chair of the Federal Reserve.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed. He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
That was President Trump over the last few months, his rhetoric around Fed Chair Jay Powell. It's in chronological order, and I want to point people to the part just before the last soundbite where he said he's spending $2.5 billion rebuilding the Fed. Mike, is there any there with this new line of attack when it comes to this renovation?
Well, there are questions about why the renovation has gone up from $1.7 billion to $2.5 billion. And I suppose those are things that could be investigated, and Powell has asked the Fed's Inspector General to look into it. The Fed's response so far has been that these plans were approved in 2021, and obviously right after that we had a big inflation, and so the costs of everything have gone up. They have also argued that a lot of things that the administration is focused on, or some of the administration officials who've tweeted about it are focused on, are things that are actually not in the final plans. And so it doesn't appear that there's a lot there. Is it enough for cause to fire a Fed governor? That would be up for the courts to decide. And as I said, that would take some time. So I don't know that that's a big deal. In that string of Trump quotes, I would also point to the one where Trump said, "I was surprised he was appointed." Well, Trump appointed him as chair.
Yeah,
good reminder.
Tim is eager to make that point. He did also express surprise that Biden renominated him, President Biden. I do want to get your thoughts, Mike McKee, on the idea that, okay, his term as Fed chair ends in May 2026. We know that. We also know that his term as Fed governor doesn't end until January 2028. We had Treasury Secretary Scott Bessent join Bloomberg Television yesterday, and he said that would be very confusing for markets if Powell did stay on as a governor until January 2028. What does the precedent look like there?
Well, there really isn't a precedent. The closest you can get is back in 1951, the Treasury-Fed Accord, where the Treasury Department and the Fed agreed that Treasury would handle fiscal policy and the Fed would handle monetary policy. And the Fed chairman at the time stepped down. President Truman appointed a new chair, but the old chair stayed on for a couple of years as a governor. But it wasn't a matter of standing up to the administration at the time. He was actually asked to do that, to lend his experience. In this case, this would be a completely unusual situation. The only close analogy I could come up with would be Paul Volcker, who faced a rebellion among his fellow board governors, and the Reagan White House told him, "We think this means you need to go." And he did resign, but it was a kind of different situation than we have right now. So this would be, as Scott Bessent said, a completely confusing mess for the markets, particularly if the president appointed someone he's seen as a toady to him that would just try to lower interest rates regardless of economic conditions. The next thing that would happen would be Governor Powell would offer a speech and it would get massive coverage, and the markets would be torn between which ones to believe. It's also, and this is important, Tim and Katie, to realize that the Open Market Committee that sets interest rates selects its own chairman of that committee, and it doesn't have to be the Fed board chairman. So the president could appoint Kevin Hassett as the Fed board chair, and the Open Market Committee could just keep Jay Powell as its chair. And so interest rates wouldn't be any different than they are right now.
All right, Michael McKee, we're going to have to leave it there. Michael McKee, Bloomberg News international economics and policy correspondent. He's out there in Victor, Idaho. Tomorrow, he's going to be speaking to San Francisco Fed President Mary Daly, so be sure to tune in to that. I'm Tim Stenovec, along with Katie Griefeld. Let's take a look at some stocks on the move today. We're joined by Bloomberg News equities reporter Alexandra Semenova. Alex, what's got your attention today?
Hey guys, well, it was a really difficult time for most investors back in April through the tariff volatility, but it was a fantastic time if you were a trader at Goldman Sachs. The firm's equities unit posted its largest trading revenue haul in Wall Street history. Most people thought it would be good, but not this good. Equity trading revenue for the second quarter came in at $4.3 billion. That's $600 million above what Wall Street analysts expected. That also helped push profit expectations for the period. And trading desks across Wall Street benefited from the volatility, but actually surprisingly for the quarter, Morgan Stanley, Bank of America, and JP Morgan's actually slipped a little bit. Goldman has been trying to build out its trading business. It's Wall Street's most profitable, to compete with the likes of Morgan Stanley and market makers like Jane Street and Citadel. And obviously this quarter is a testament that that effort has been successful. The stock is up just a bit today, 0.5%, but it's up 22% this year through yesterday's close.
Yeah, tough crowd, right? When it comes to Goldman, you post a record trading.
And it wasn't enough
quarter.
for investors, I guess, because financials have run up so much this year.
That's true. The bar was high. How about ASML? We were talking, not in this show, but I was talking yesterday about NVIDIA seeming...
We talked about it too.
I'm sure you did. I was home. But anyway, talk to us about ASML, because it's not a blanket good news story for these chip makers.
Right. A company that is not faring too well through all of the tariff uncertainty. Its CEO today walked back his forecast that sales would grow next year, blaming trade disputes and global tensions. Back in October, he actually told investors that 2026 would be a growth year for the semiconductor industry. Not so much anymore. ASML instead took a more cautious stance today when it reported its second quarter earnings. Its chief financial officer said that clients are more worried about the global trade war than they were back in April. He said our customers are more concerned about the tariffs discussions today than they were 3 months ago. Countries are in full battle mode. Again, ASML forecasts third quarter net sales between 7.4 billion euros and 7.9 billion euros. That was below the forecast of 8.2 billion. It expects revenue of 15% growth for the next year.
Okay, in the U.S., the ADRs are ASML U.S. down 8.3% right now. Out in Europe, in Amsterdam, down 11.4% on the day. So quite the hit.
Tough day for them.
All right, Johnson & Johnson, a little bit of green there.
Yeah, so interesting how differently these companies have been navigating all of this. Johnson & Johnson, a company that is faring much better. It beat Wall Street quarterly sales expectations and raised its full-year outlook. Obviously, what companies are saying about their outlooks is so important this earnings season. This is also a show of confidence at a time that the pharmaceutical industry faces the threat of tariffs. The strong results from the sector come even as President Trump floated the idea of tariffs on the sector. On Tuesday night, he said that they could probably come at the end of this month, start slowly and work their way up. He actually told reporters he would impose tariffs of as much as 200% on the sector over the next year to 18 months if companies don't move their businesses here to the U.S. And the CFO of Johnson & Johnson actually said that the gradual approach was a good thing. It's a testament that Trump understands that this can't happen overnight. So obviously investors are taking those remarks positively. Mizuho also said that a notable takeaway is the increase in guidance in the face of so much regulatory and policy uncertainty.
J&J shares up about 6% as we speak. Alex Semenova, she's Bloomberg News Equities reporter. For more conversations like this, check out our new Stock Movers podcast. You can subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Katie Griefeld, you have been here since the wee hours of the morning, so but you get to leave.
This was one of the better hours, I have to say.
Oh, it's so nice. It was fun. Come back. Hang out with us again.
Maybe.
On Bloomberg TV, the close is up next. If you're sticking with us on radio, Isabel Lee next.